What's going on, investors? Happy 4th of July. If you hear some loud noises in the background, know that it's fireworks and not whatever else you were thinking. But today I got 3 REITs that are down considerably this year that offer great dividend yields and should be able to cash flow for years to come. Now, REITs, they are a fantastic way to get exposure to real estate without the headaches of being a landlord and managing tenants. REITs are also liquid, meaning if I need to get my money out right away, I can just sell my stocks. I don't need to hire an agent and go through the long and expensive route of finding a buyer in the open market that I would have to do with traditional real estate. All right, let's get into what these investments are. I personally own most of these in my $107,000 portfolio, and I will highlight the ones that I own as we continue to go on. Stock number 1, global data center giant. Equinix provides data center solutions all across the world, operating in America, Europe, the Middle East, Africa, as well as its Asia Pacific locations. A data center is a facility that houses the computer systems and network infrastructure for businesses to be able to store large amounts of data and run their applications and services. Yeah, if one of these data centers goes down, businesses are in big trouble. As we've seen in the past, when Amazon Web Services goes down, it seems like the whole world just basically shuts down until they fix their issues. So we have Microsoft, Amazon, and Google. They're all big customers of Equinix. Equinix actually has over 220 different locations around the world. Now, last quarter, they brought in $1.7 billion in revenue, and out of that $1.7 billion, $1.6 billion was actually reoccurring revenues. So just like clockwork, I can expect the money to keep coming in every single quarter. In fact, this was the 77th straight quarter that they had revenue growth. The company operates as an essential business. I like how in the TV shows, the villain always just walks right into these data centers. They pop open their own laptop, they plug it in, they press like 3 keys without even looking, and boom, the whole town's power is gone. Yeah, it's not so simple in real life. These facilities are state of the art. They have to be very secured to prevent attacks. They have to have the right temperature because it's going to get really hot in there, and they want to prevent overheating. They also need to have generators in order not to be affected by power outages, and etc. That's why people pay Equinix the big bucks, is to take care of all this for them. And in return, the company rewards us with dividends for being a shareholder. They might have a small starting yield at just 2%, but this company is up over 300% in the past 10 years in actual share price. Their 5-year growth rate of their dividend is around 10%, and they have a really low payout ratio of just 40%. So imagine getting a double-digit pay increase every year and the chances of those payouts to continue going on in the future because the payout ratio is pretty low. I'd love for them to do a stock split one day, but not all my wishes come true. I currently own 3.14 shares in honor of Pi Day, and it's worth $2,100 in equity, and I get paid $39 every year from this data center giant REIT. Stock number 2, I keep getting requests on this one. Arbor Realty, not reality, ticker symbol ABR. This is a company that gives out loans for investors to buy real estate, and they specialize in multifamily originations. They currently have a servicing portfolio of $27 billion. Now, I was initially a little bit hesitant with this one, as this industry, it typically does not perform well in recessions. Mortgage REITs like ABR, they have amazing starting dividend yields. ABR's is currently at 11.5%, but just remember, the dividend is never guaranteed. Just like any other company's dividend payment, it can get cut or it can get suspended if times get tough, like they might be right now. Now, ABR's loan origination is a little bit different than others in this space. They actually focus on using long-term debt to fund their loans, more of a balance sheet strategy focus, as opposed to their competitors who finance with short-term borrowings, trying to profit off the spread between long and short-term interest rates. So ABR actually isn't impacted as much with rising interest rates as others are in this space. Rising interest rates will eat into these type of companies' margins, and that's why they've been performing so poorly this year. But ABR, they actually just raised their dividend for the 10th straight year. Its dividend is up 27% in just the past 2 years. So this company does seem to be doing well while the rest of the industry is struggling. Most analysts have this stock as a buy. Get this stock on your radar, do your own research, and see if it fits your risk tolerance, if that 11.5% dividend yield is truly worth it to take on this extra risk. Stock number 3, Warren Buffett owns it. Generally, you can't go wrong with investing in most of Warren Buffett's personal investments, and Store Capital is no exception. Store currently owns over 2,900 different properties across 49 different states in 120 industries, serving 573 customers. The company specializes in single-tenant operational real estate, hence the acronym for its name. Some of their biggest tenants are Camping World, Bass Pro Shops, AMC Theaters, so you definitely know this REIT is going to the moon. Store is heavily involved in service-oriented industries such as restaurants, gyms, early childhood education centers, and the manufacturing industries, which includes metal fabrication and food processing. These are all areas that we need in our day-to-day life, and they should continue to strive in a recession. It's estimated the addressable market for Store is around $4 trillion, and that's potentially 2 million different locations where they could set up shop. So certainly a big piece of that pie for Store to nibble on and try to get some more exposure to. The company has actually grown their AFFO 5.7% annually since they IPO'd in 2014. The company has also raised their dividend on average 6.1% annually, so I'm expecting more and more dividend rises on the horizon. Store has a very impressive starting yield of 5.73% while we wait. Warren Buffett currently owns 14.7 million shares of Store worth just under $400 million. That's actually over 5% of all Store's shares outstanding. That's definitely a lot in dividends every year. Now, I own slightly less than Berkshire, controlling 48 shares worth $1,300 in equity, and I bring home $74 every year. Now, that might not seem like a lot of money at the end of the day, but I don't have to worry about all the headaches that come with being a landlord, and I can just sit back and keep collecting those checks stress-free with Store's amazing 99.5% occupancy rate. Let me know what you think of the stocks I mentioned in the comments below. If you have any other favorite REITs, or if there's a video request that you want me to do, make sure you share them in the comments below. Make sure you hit that like button for the algorithm. It really does help out. As always, my videos are found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.